In this lecture, we'll be talking more about Forex analysis while focusing on technical analysis. So, there are three types of analysis in Forex. First, we have the technical analysis. Secondly, we have the fundamental analysis. And lastly, we have the sentimental analysis. But for the sake of this course, we'll be discussing only the first two types, which are the technical and the fundamental analysis. In this particular lecture, we'll focus on the technical analysis, and in the next lecture, we'll talk about fundamental analysis. So, what is technical analysis? Technical analysis is a range of techniques used to try and forecast future price movements of financial products based on historical price movements and patterns. Now, let's talk about support, resistance, and trend lines, or SRT. So technical analysts use support and resistance levels to identify price points on a chart where the probabilities favor a pause or reversal of a prevailing trend. So what is support? Support occurs when there's a downtrend, when a downtrend is expected to pause due to a concentration of demand. So it's like it serves as a floor for price. And resistance occurs when there's an uptrend or when the uptrend is expected to pause temporarily due to a concentration of supply. So resistance serves as a roof for price, while support serves as a floor for price. So this is a graphical illustration of what a resistance looks like. You can see this line here is the resistance, and each time price came to the resistance, it fell. It came back to the resistance and fell again. Came back to the resistance and is falling for the last time. So this is serving as a floor for price. Each time price comes to that point, it starts to fall. And this is a graphical illustration of a support level. So you can see that price, whenever price comes to this level, it rises. Whenever it comes to this level, it rises back to the level and rises, coming back to the level and rising one more time. So this serves as a floor for price. So it's difficult for price to break beyond or below this level. Now let's talk about trend lines. So trend lines are used to determine the direction of the current trend. In an uptrend, price remains above the trend line, which is drawn to connect the higher lows of the uptrend. Similarly, in a downtrend, price remains below the trend line, which is drawn to connect the lower highs of the downtrend. So this is a graphical illustration of what an uptrend looks like. You can see that price kept on creating higher highs and higher lows, and then the trend line connects the higher lows together, forming the uptrend line. And you can see that each time the price touches the trend line, it bounces away from it. Each time the price touches the trend line, it bounces away from it. So notice how the ascending trend line is able to prop up the price of the Newmont Mining shares for 6 years. So we'll talk about this topic in detail in the mentorship. Now let's talk about technical indicators. So Forex indicators are one way of examining market data. By examining historical data such as currency, price, volume, and market performance, indicators seek to predict how the market will behave in the future and which patterns are likely to be repeated. Once traders have this information, they are able to make more informed trading decisions and make higher returns as a result. Broadly speaking, there are 4 different types of Forex indicators, which include Forex trend indicators, Forex momentum indicators, Forex volatility indicators, and Forex volume indicators. So let's dive deep into each and every one of them. So the types of indicators, categorized into 4 broad categories. There are numerous different types of Forex indicators, and it's useful to know what each one does before trading on your next market account. The most common Forex indicators are, first, the trend indicators. You have the average directional indicators, the moving averages, and the parabolic indicators. Secondly, you have the momentum indicators, like the relative strength index or RSI, and you have the moving average convergence divergence, which is which abbreviation is MACD or MACD, as we popularly call it. Then thirdly, you have volatility indicators like the Bollinger Band and the average true range. And fourth, you have the volume indicators like the accumulation distribution line and the Chaikin money flow. For this course, we will discuss only 2 of these indicators just to make it brief. The rest will be explained more in the mentorship. So this is a chart with multiple indicators. Here you can see the Bollinger Bands, their moving averages, all on the same chart. Let's talk about moving averages. So moving averages can also be used to identify a trend direction. The easiest way to do this involves plotting one simple moving average on a chart and then checking if the exchange rate is above or below the moving average. If the exchange rate is higher than its moving average, that will signal that the currency pair is in an uptrend. So if price is currently trading above a moving average, it signifies that price is currently in an uptrend. And the opposite is for a downtrend. If price is trading below a moving average, then you can say that the price is in a downtrend. You can also compare two moving averages in a similar way. For example, a 100-day moving average and a 200-day moving average. In that case, the indicators would signal an uptrend when the 100-day moving average is higher or crosses above the 200-day moving average. You can even use moving averages crossovers as trading signals. So whenever one moving average crosses over the other one, it could signify that price is about to change the trend, and it could give you an entry to go long or short depending on the market direction. So this is an example of a moving average on a chart. You can see that the moving average serves as a dynamic support and resistance. So whenever price is above the moving average, it's in an uptrend, and each time it comes back to the moving average, it rejects it and continues in the upward direction. You can see that here, here, and here, even here as well. And when price crossed below the moving average, then we went into a downtrend, and you can see that when price comes back to the moving average, it rejects it and acts as a dynamic resistance. It happens here, 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 and here as well. So let's talk about the RSI, or the Relative Strength Index. The Relative Strength Index, or RSI, can help you to figure out if a currency pair is overbought or oversold. The default period for calculation is 14 candles or bars, and the RSI's value oscillates between 0 and 100. An RSI reading of 70 or higher is considered in an overbought territory or overbought market, while a value below 30 suggests that the currency pair is oversold. So we can see a graphical illustration of the RSI here, and you can see on this chart, whenever price crosses the 70% mark, which is the line above here, this is the RSI indicator right below the chart here. So the line above signifies the 70% point, while the line below signifies the 30% point. So whenever price goes above the 70% line, it signifies that price is overbought and you should start looking to sell the market. And whenever price crosses below the 30% line, it signifies that price is oversold and you should consider to start buying in that market condition. So moving on, we have stochastic oscillator. So market movement evolves through buy and sell phases, which can be identified through the stochastics and other relative strength indicators. These cycles often reach a peak at overbought or oversold levels and then shift in the opposite direction, with the two indicator lines crossing over. Cycle alternations don't automatically translate into higher or lower security prices as you might expect. Rather, bullish or bearish turns signifies periods in which the buyers or sellers are in control of the ticker tape. It still takes volume, momentum, and other market forces to generate a price change in the market. So what this is trying to say is that price being in an overbought condition is not a strong enough signal to let you know that you should start buying the market. And also for an oversold condition, when price in an oversold condition, it's not a strong signal for you to go long in that market. Now this is what a stochastic looks like on the charts. This right here below the chart is a stochastic indicator, and you can see there's a line here for signifying the overbought and the line below signifying the oversold. So it's more like an RSI, but in this case it has two lines which can cross each other to signify or give a signal to go short or long, as the case may be. You can see here that when price was in an overbought condition and the two lines of the stochastic crossed, you can see that price started to sell from that point. So it gave a sell signal. Same thing happened here when price was in an oversold position, and price crossed, the two lines of the stochastics crossed, you can see that price started to rally to the upside. So it gives an indication or a signal for buys. Same thing happened here and here as well. So the stochastic can be an indicator to tell you when the market is overbought or oversold, and also give you entry signals because of the two moving averages on the stochastic. Now let's talk about the moving average convergence divergence, or the MACD. So the moving average convergence divergence indicator is usually set at 12, 26 and 9, and it gives novice traders a powerful tool to examine rapid price changes. This classic momentum tool measures how fast a particular market is moving while it attempts to pinpoint natural turning points. Buy or sell signals go off when the histogram reaches a peak and reverses to pierce through the zero line. The height or depth of the histogram, as well as the speed of change, all interact to generate a variety of useful market data. So this is what the MACD, moving average convergence divergence indicator, looks like. And you can see that when price is above the zero line and crosses towards the downside, it gives us a sell signal. As you can see here, price started to sell after this cross right here. And then at this point too, when the lines crossed over below the zero line, which is this straight horizontal line in the middle, we can see that price started to move to the upside. Same thing happened here. After the cross to the downside, price followed it to the downside. So this can give entry signals for trades for novice traders or beginner traders like you. So next we have the Bollinger Bands. So the Bollinger Bands are a technical analysis tool developed by John Bollinger for generating oversold or overbought signals. These are three lines that compose the Bollinger lines: a simple moving average, which is the middle band, and an upper and lower band. The upper and lower bands are typically two standard deviations from a 20-day simple moving average, but they can be modified. I'll explain what this means. So you can see what the charts look like with a Bollinger Band on it. So you can see the Bollinger Band has three lines, this being the first line, this being the middle line, and this being the third line. So the middle line is just a simple 20 period moving average, and then the line above it and the line below it are standard deviations of this middle moving average right here. So it can also give signals for overbought and oversold conditions in the market. Whenever the market goes above the upper band of the Bollinger Band, it signifies an overbought condition, so we should look to start selling the market. Same goes for when the market is below the lower band, we should start looking to buy because the market is in an oversold condition. You should tread carefully when using this indicator for your entry signals, because it's not as accurate, it's not very, very accurate. So it's just for confirmations and not as a strategy on its own. Now let's talk about Fibs. Fibs stand for Fibonacci retracements. So what are Fibonacci retracements and Fibonacci ratios? Fibonacci retracements are popular among technical traders. They are based on key numbers identified by the mathematician Leonardo Pisano, nicknamed Fibonacci, in the 13th century. Fibonacci's sequence of numbers is not as important as the mathematical relationships expressed as ratios between the numbers in this series. In technical analysis, a Fibonacci retracement is created by taking two extreme points, usually a peak and a trough, on a stock chart and dividing the vertical distance by the key Fibonacci ratios of 23.6%, 38.2%, 50%, 61.8%, and 100%. Now, this is what the Fibonacci ratios look like on the charts. If you draw from a peak, which is from one point to the other, from a peak to a trough in the market, it plots out these Fibonacci ratios in the market. So you can see the 23.6%, 38.2%, 50%, 61.8%, and 100%. And this can help you to identify points of retracement in the markets. It can also give you ideas of where the market is going to reverse. So we're going to talk more about Fibonacci retracements in the mentorship. We'll dive deep into it and explain everything and even give you strategies on how to use the Fibonacci retracement in the mentorship. So with that being said, We've come to the end of this lecture. I hope you learned a lot. If you want to learn more about Fibonacci retracement and strategies that are built around Fibonacci retracement, you can subscribe for the mentorship, and we give a lot of quality educational content over there. Thank you for coming on this lecture.